The economy, of course, in focus this week. We had upbeat manufacturing numbers out of China and the U.S., easing fears of a recession. I spoke with Minneapolis Federal Reserve President Neel Kashkari last week. Here's what he said about the risk of recession after we saw that yield curve inverted.
There's always a possibility that there would be a recession a year from now or 18 months from now. I think the economists call it the unconditional probability. On any given year, there's about a 15% chance that the next year there would be a recession. I think those recession odds are elevated right now based on these signals from the yield curve.
But overall, he was pretty positive, saying that maybe it is on the horizon, but not over the near term. Joining us right now to talk more about that is UBS Financial Services Private Wealth Advisor, Alli McCartney. And Alli, it's good to have you this morning. Thanks so much for joining us.
Thanks for having me.
How big of an issue is this slowdown in the economy in terms of investing in stocks right now?
Look, I think that we've come off of one of the greatest years that we've seen in decades, and that was largely fueled by all of the money that global central banks have been printing in the tax package. So now we're at a point where we're really looking at what's the consumer doing, what's global growth going to look like, and being 10 years into a U.S. boom, U.S. investors are looking globally about sort of who and what is next. So as you said, yesterday, having positive numbers come out of both China from a manufacturing perspective and the U.S. was huge. And so that and some excitement about potentially some progress on the trade front between U.S. and China last week and meetings resuming this week led to yesterday, an 1.5% almost up day after one of the greatest starts to a year we've seen.
So what are you advising your clients right now? Because Neel Kashkari is talking about the inversion of the yield curve, and that has been a very good predictor of recessions, but that doesn't usually happen until about 18 months. And in the meantime, the market usually moves higher, about 21% over that period of time. So how do you position your clients over the next 18 months or so ahead of that?
So what you said, Lindsay, is literally the conversation we've been having, right? We were getting questions about the yield curve. We're not so worried about the inversion of the yield curve. Global central banks have been printing money at nauseum. They've been forcing the long end down. So it makes sense that you have that sort of couple months versus first 10 years. And the twos and the threes and the tens have stayed okay. We think it's sort of lost predictive power. And as you alluded to, the other thing that happens with that is it does have maybe a decent predictability, but the variability of the tenor of that, we all know that we're 10, 11 years into a bull market. There's some slowing. We see more slowing in the first and second quarter as a result of some of the idiosyncratic headwinds and things from the tax package as well. But, we think that you can invest in discrete stocks. We have taken risk down a little. We've taken that out of the emerging markets. We've taken that out of international. So we're still relatively overweight U.S. We are, within the U.S., we are long financials, which are at a 10-year relative valuation low. And as you saw yesterday, when you had this positive news, they were the outperformers largely. We're long technology because we think we're at the point in the cycle, as because of everything we have talked about in the last few minutes. This is time for growth, probably not value.
Real quick before you go, we got a jobs number out on Friday, and we're right on the doorstep of first quarter earnings. What are your expectations?
I think the jobs numbers continue to be good, right? And so what we're looking at in the jobs numbers is really some of the components of employment. And are we not just simply are we creating jobs, but are people coming back into the workforce? What is the wage growth looking like? The thing about the jobs number that concerns us is the potential for that to create inflation, which then would move the Fed, and then you sort of get into this circular argument about where are interest rates and, what's going to happen in the system. But, I think for earnings, we are expecting a slowdown in the first and second quarter. We think that will pick up in the third and fourth. So what we'll be primarily focused on is what is the 2019 and 2020 thoughts? What are they seeing in the economy? What are they seeing throughout the globe? And how are they feeling from both their ability to get out in the market to create value and to expand?
All right, we will leave it there. Alli, great to get your insights. Thanks so much. Alli McCartney, UBS there.